Welcome to The Explainer. We're going to talk about how to spot bad stocks. I've got two super simple but really powerful red flags that can help you steer clear of some major investing pitfalls. And trust me, they're way easier to use than you might think.
All right, so let's get right into it. This is probably the biggest question every single investor has to ask themselves, right? A company comes out with these huge profit numbers. But is that profit actually real? I mean, how do you know if you can trust what they're telling you?
Well, to get to the bottom of that, we've got to look past the flashy headlines. We need to understand this really fundamental difference between the profit a company says it made, on paper, and the actual cash it has sitting in the bank. Believe it or not, those two things aren't always the same, and that gap, that's where things can get really risky.
Think of a company's financial reports as telling two different stories. First, you've got the profit and loss statement, the P&L. It shows sales, it shows expenses, but here's the catch. It can include sales made on credit. That's money the company hasn't actually received yet. So you could say the P&L is more like an opinion of how profitable the company is. But then you have the cash flow statement. That one is pure hard fact. It only tracks the actual cash, money that's physically in the bank.
Okay, let's make this super simple. Let's say a company sells 100 rupees worth of stuff on credit. The accounting rules let them book a 20 rupee profit right away, even though they haven't been paid yet. But what if the customer just never pays? Well, the stuff is gone, no cash ever came in, and that 20 rupee profit, poof, it was an illusion. It was never real money.
Okay, so here's the big takeaway from all this. We need a way to check if those profits a company claims are actually turning into real cash over the long haul. And lucky for us, there's a really simple test for this. You can think of it as a kind of financial lie detector. And it's so easy to do. All you have to do is go to the company's financial reports and add up their total net profit over the last 5 years. Then do the exact same thing for their cash flow from operations for those same 5 years. Now here's the key. In a healthy, honest company, those two numbers should be roughly the same. Let's look at a couple of real-world companies to see what I mean.
All right, first up, let's take a look at a healthy company. This is what you want to see. This is the kind of thing that tells you, okay, I can probably trust these guys. So over 5 years, Godrej reported a total net profit of around 4,900 crore rupees. That's the number from their P&L statements. Okay, but now for the moment of truth. We look at their operating cash flow for that same 5-year stretch, and what do we find? A total of about 4,800 crore rupees. I mean, look how incredibly close those numbers are. And that right there is a beautiful sight for an investor. The profit they claimed on paper is almost a perfect match for the cold, hard cash that actually came into the business. This is a huge green flag. It tells you that, yeah, the profit is real.
But now, let's flip the coin and see what a big, flashing red flag looks like. So this company reported a 5-year profit of about 50 crore rupees. Okay, but when we run our little cash test, we find they only brought in 21 crore in actual cash. Whoa, that is a massive, massive red flag. More than half of the profit they claimed, it just wasn't real money. It never showed up in the bank. A gap that big should make any investor stop and think twice.
All right, let's move on to our second big red flag. Now, this one's a little sneaky. It's something companies do that on the surface looks like an amazing deal for shareholders, but it can actually be a trap. I'm talking about something called a rights issue. So what in the world is a rights issue? Well, it's pretty simple. The company basically gives its current shareholders the right to buy more shares of the company, and they usually offer them at a really nice discount. So if the stock is trading on the market for 100 rupees, they might turn around and offer you new shares for just 60 rupees.
I mean, that sounds awesome, right? Getting shares on the cheap? What could possibly go wrong? Well, the hidden danger, the thing that can bite you, is a little something called dilution.
Okay, to see why this is a problem, let's just break down the math. It's actually pretty simple, and it shows exactly how this discount can end up being really expensive for you. Let's imagine a company makes a profit of 300 rupees, and let's say it has 100 shares out there. Simple math, right? That's 3 rupees in earnings for every single share. We call that EPS. But now the company does a rights issue, and suddenly there are 300 shares. The profit is still 300 rupees, but now you have to spread that same profit across 3 times as many shares. So what happens? Your earnings per share completely collapses, all the way down to just 1 rupee.
And this puts you, the shareholder, in a really tough spot. It's basically a lose-lose. You can either pony up more money to buy the new shares just to keep your piece of the pie the same size, or you can do nothing, don't apply, and just watch as the value of your original investment gets watered down. Either way, you're not really coming out ahead.
Okay, so let's wrap this all up. Let's boil this down to a simple 2-point checklist that you can use to protect yourself. So here are the 2 big things to watch out for. Red flag number 1, cash from operations is way lower than net profit over 5 years. If you see that, be careful. The profits might not be real. And red flag number 2, the company is constantly asking for more money through rights issues. A healthy company shouldn't need to do that all the time. It's often a sign that something's not right under the hood.
So I'll leave you with this question to think about. Now that you know this simple 5-year cash test, maybe it's time to take a look at your own portfolio. Go ahead, run the numbers on the companies you own. You might just be surprised by what you find. Which of those profits have actually turned into cash?